Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time January 2024. It's good to be back, and it's good to have my voice back. I know I sound like I've been partying with the rock band, but it was just a good old Wisconsin cold. And as some of you know, before that, I had a little adventure trip in Patagonia. It was absolutely epic. So if you ever thought about going to Patagonia, let me tell you, it's better than you think it is. Totally worth the trip. But I'm glad I'm back and ready for the spring market. Today we're going to talk about what we can expect for buyers and for sellers early on in 2024. And getting into this, let's get started with a look back at the latest numbers right out of MLS. So I have a December numbers. Inventory up a little bit, 2,700 units. That's up 6.5% from the previous year. And a little change here, I have now below December of 2019 and December of 2015. So 2015 was the last time we had a balanced market, but it's getting so distant that I've decided to put the year before COVID in here as well. So you have a comparison, and you can see here really nice how we went from 10,000 to 5,000 to under 3,000 units in inventory. Which is, gives you the context to really understand where we are with inventory, with housing supply. Sold units, 1,500, that's down 9.2%, much better than we started out 2023. So there's a lot of positive trends happening in 2023 that I believe will carry forward into 2024. Velocity appropriate for the season, I would say 15 days. You may recall in June and July we were down to 5 days on market, which is just physically the shortest you could even do it. Now we're back at 15, and I already see in January this is already picking up again in velocity. Prices, we finished the year in December with 290,000. If you look at year total numbers, a little over $300,000. Either which way you look at it, we're up 7.4% in pricing. So, at this point, the data set is large enough that you can say Milwaukee home prices went up about 7.5% last year. I think we're going to see this trend continue. Competition is very strong, demand is very strong, and there's a number of reasons why it will actually gain momentum. So we'll probably be very quickly in the low to mid 300 range. We'll see that in the next 2 or 3 months. Inventory wise, January is always the lowest inventory. So if you're looking right now on Zillow, or if you even have MLS access, then you will see there's not much out there. This is perfectly normal for this time of the year, and it's going to get more. So what's happening every year is that buyers are the first one out. After the holidays, they're like, yeah, let's buy a house. Sellers take a little bit longer. They start talking to their agents, getting the house ready. We have a few listings that are currently being painted and getting ready for being listed in the next weeks. That just takes a little time. So be patient. You will see more inventory hitting the market in the next few weeks. The lower mortgage rates, and we'll talk about mortgage rates a little bit more later in the video, that have an impact both on buyers and on sellers. So there's a lot of people that are coming back into the market that have left the market for a while. So there's going to be a change in volume. And as far as what's driving the market overall, this probably warrants a video by itself. But it's still the demographic shift that is happening. We have on the seller side, we have a lot of boomers, retirement age. Almost all the sellers that I meet are in that age bracket, and almost all buyers are millennials. The oldest millennials, now 40 years old, family, babies. They're sick and tired of getting renting. Renting has gotten so competitive in Milwaukee. We've seen rent increases over the last 2 years. We'll be in for another round this year. And a lot of them have just decided they're over it and they want to buy a house. So they're forming their first household, and this is where the demand is coming from. And the inventory is the result of the forces of supply and demand. This is why you see it from going from 10,000 to 5,000 to under 3,000 where we are now. Let's take a look at sold to list price ratio. This is a very important metric because it shows you the competitiveness in a market. So in a nutshell, this is basically what on average buyers ended up paying for a property over or under list price. So if this metric is over 100%, then the majority of them paid more for the house than it was actually listed for. And we have here a very stable seasonal curve. This is very typical, but it's just a lot higher than what we have seen it in the past. So you can see your peak spring summer market last year. we were at over 103%, which means a lot of deals went 10% over asking, 50,000 over asking. On a hot listing, we've seen that a lot. December, as expected, that number came down. And I think what we're going to see in the next few months is pretty much a replay of what you see on the left side on the chart, what we've seen last year in spring. Keep in mind that this is an indicator that's lagging 30 days approximately. So the market has already been very competitive. I've been keeping tabs on my team, what was going on. We've written a lot of offers in general already, and a lot of them were in a very competitive situation. I recall in West Allis we had 2 different duplexes. One had 14 offers, the other one had 23 offers. So already a very, very competitive market, and we will see this transpire also in this metric when we look at next month's data. All right, let's take a look at inventory. So this curve looks relatively flat, but when you really think about it, we started the year right around 2,000 units for sale, and now we're kind of like in the 3,000 territory. So usually this comes down towards the end of the year. So good news there. We're seeing a trend towards more inventory. Finish the year with 50% more. I believe this is a trend we're going to continue to see. So there's going to more inventory on the market this year. Not like enough that it really changes the dynamic of the market, but at least it will take a little bit the edge off that super scarcity that we had seen in the last couple of years. So that's a little bit of good news. When you look at new listings, so this is what's coming on the market every month. Also seasonally very appropriate. Nobody's listing the house in November and December if they have a choice. So this is coming down quickly. And we expect the new listings going up now more in a little bit in February and then more in March. So inventory is going to come. We'll also talk a little bit about the impact of interest rates on sellers, because that will be positive news as well. Before I get there, let me introduce you quickly to our new buyer's guide. So if you're thinking about buying a house or a condo or a duplex in Milwaukee, this is absolutely for you. It's about 28 pages. We've put that together recently. It is very specific for the Milwaukee market. It is designed to give you an edge in this very competitive market. We always lead with education. We believe that the more our clients know, the better they understand everything, the better the outcome. So in that spirit, we've put that guide together. And we supply this to all of our clients. And if you want to download it from our website, you can do that on onpointrg.com. And this, by the way, is not only for new home buyers. Even if you bought houses before and you know generally how the process works, I have put a lot of stuff in there that will actually help you make sense out of what's currently going in the market and how to gain a little bit of a competitive edge. So you can download that on our website. What you also can do is request access to the MLS, so you don't have to look on Zillow and Realtor.com. We can set you up with MLS. Just do that on our website. And if you want to, you can certainly also book an appointment with me. We'll hop on a Zoom call or on a phone call, and that's available on the website. Let's take a look at what's going on with the economy, because that is, when you look on a macro picture, that's the major driver on what will be happening in the housing market. And the main thing that we really have been following here the last year was inflation. Inflation has a huge impact on real estate, because real estate tends to, it's a hard asset. Hard assets tend to hold their value during times of high inflation. But now we have a shift in dynamic. The Fed seems to be content with what they have achieved with getting inflation under control. And you can see here on the red line, inflation has come down nicely. We're right around 3%. That seems to like stabilize on this level. And they still want to get it down to 2%, but they already indicated that they're going to ease the interest rate environment, which ultimately indirectly will also help with lower mortgage rates. We'll get to that in a second. The second line that you see on this chart is wages. That's the blue line. And the significance here is that at the moment, wages are growing faster then the currency is losing value with inflation. And the net result of that is that buyers have more purchase power. So after that red period that you can see highlighted where people really lost purchasing power, it's good to be back in the green where people are gaining purchasing power, because that is actually going to help with affordability. And that's the next thing I want to take a look at. So let me quickly explain what you're looking at here. The NAR is publishing an affordability index, and an affordability of 100 basically means that a median, a typical household can afford a median typical home. That's 100, so you can afford one house. And we have seen affordability decline during the COVID years rapidly for two reasons. Home prices went up and mortgage rates went up. And the combination of that, of course, made the monthly payments a lot higher, and that had a negative effect on affordability. So I'm sure you've seen a lot of headlines in national news about how bad affordability has gotten, how high home prices have gotten. Always take this with a grain of salt, because Wisconsin has turned out to be a very, very different market than the national average. We're priced much, much lower than the national average. You know this if you've been following my monthly market updates. And that also translates into affordability. So on the right side of the chart, you can see US national affordability below 100. So a typical family cannot afford a typical house anymore. But in Wisconsin, we are still at 127. And that is going to improve both on a national level and on a local level. And let me walk you through why this is going to happen, because this is very important to understand. So what goes into affordability? Basically, mortgage rates, the income that households are making, and home prices. The higher home prices, the higher mortgage rates, the more expensive it's going to be. And the lower incomes are, of course, the more difficult it's going to be. So that goes into the equation. But the interesting thing is that home prices don't really have as much of an impact as the other two factors. So for example, and this is just rough numbers, but I want you to get a sense for this. If you have a 5% increase in wages, which is what we are currently seeing. So for a $100,000 household income, husband and wife both making combined $100,000, this means a $5,000 increase in income. If you are willing to commit $5,000 more a year to your mortgage payment, that translates roughly orders of magnitude into $100,000 more of a mortgage or more of a house purchase. So there is a huge upside in when household income is increasing. Just a little bit more helps actually a lot with affordability. Mortgage rates also have a pretty strong impact, not quite as much, but if mortgage rates go down by 1%, that actually means that you can afford about $50,000 more on a house, roughly on a $400,000 property. So you can see these metrics have a very large impact on the affordability. So we will keep a track on this, because this will be very much influencing the housing market this year. Let's take a look at prices. So also here, I would like to start with a little bit of context. And I have here a long-term chart that shows you this data from Freddie Mac. This shows you real estate appreciation over the last 42 years. And what you see here is the average is at 4.92, so just under 5%. Obviously, famously, you have the 2007, 2008 big subprime mortgage crash years that really took a toll on the real estate market. But other than that, we have always seen some form of appreciation. It also correlates with inflation. More inflation usually means house prices go up faster, but we always have some sort of appreciation. On average, this comes out to about 4.9%. Now let's take a look on what the home price forecast is for 2024. And this is from a number of institutions that are worth following. We have the Mortgage Banking Association, Fannie Mae, Freddie Mac, the Home Price Expectation Survey, Goldman Sachs, National Association of Realtors, Zillow, and Realtor.com. And most of these have been actually on the negative side over the last few months or quarters, I should say. And they're all now getting more optimistic with the housing market, all getting into the green. But everybody is still predicting less than the 4.9 we had on average. So everybody's still pretty careful with the prediction. On average, this comes out to the blue here, 1.5. Very important to understand that this is a US national forecast, and as you remember from the first slide, Milwaukee is appreciating quite a bit faster, 4% last year than the rest of the US. And the reason for that is, quite frankly, that our real estate is still relatively cheap compared to the rest of the country. We see this every time when we're out there with relocation clients from the East Coast, from the West Coast, even from the South. They're looking at Milwaukee homes, and in their mind, everything is for sale here because prices are still relatively low. So from that point of view, I think we can expect to continue this trend also this year, that Wisconsin or the entire Midwest is going to outperform the rest of the country in appreciation. Let's take a look at the long-term picture. So here we have the next 5 years. And there is something that's called the Home Price Expectation Survey. So those are 100 leading economists, researchers, analysts from big banks, government entities. And they're being asked, what do you currently use in your financial prediction models? That gets all rolled together in this forecast. And that picture has become brighter and brighter now as well. As we're getting away from these recession concerns, it looks like the economy is going to continue to just roll on nicely. And so they're getting more and more optimistic. So we're still well below the 4.92 long-term historic average, but they're expecting appreciation in the 2% range, maybe even in the 4% range later out. Nobody can tell for sure, of course, because nobody can predict things like COVID or, that just comes out of nowhere. But if these numbers were to be true, I want to show you this example here. If you were to buy a $400,000 house and appreciation actually happens the way these guys are predicting it, then you would be gaining about $72,000 in equity in the next 5 years. This is basically a consideration when you're looking at renting versus buying. Not only you're not basically paying the rent and it's gone, you're actually paying down your mortgage, so you're gaining equity. Important to understand that you're also locking in your rate. Rents are usually going up every year. So when you buy a house, then you're locked in for the next 30 years. That payment is not going to change. So that gives you stability, but it also gives you an upside shot on appreciation if it happens. It looks like it might happen in the next few years, but you can see in this example, this is quite a substantial amount of money. Makes a bit of a difference. Now let's take a look at sellers and why we have not more inventory coming on the market. What's going on in the mind, in the psychology of the sellers, and a lot of them feel what we call rate locked because you might recall in fall last year, October, November, we've been looking at mortgage rates north of 8%. And sellers are usually also buyers. 3/4 of them will also buy a home after selling. So they're looking at their current mortgage and they say, well, I have to go from a 3% rate to an 8% rate. That is a very big leap to take. And here's a breakdown. You can see about 80%, almost 80% of mortgage owners are currently locked in less than 5%. A lot of them between 3 and 4%. And that's the reason why they have been hesitant to put the house on the market. Usually there's a reason why they want to sell their house. And when people are hesitating, then you get to the point where they're just done waiting and they just want to get on with it and put the house on the market. So we're seeing a little bit of that, but we're also seeing interest rates coming down significantly, which is also feeding into this. And that's basically the reason why we're expecting this year to have a little bit more inventory on the market, not much more, but a little bit more than we have seen in past years. Let's take a look on what's going on the buyer side. Here's a survey from Bright, a national survey again. And the interesting thing to me here is that multiple answers were allowed here, and home affordability was not the reason why people ended up not buying a home. That was the least checked box here, only 17%. Inventory was a bigger issue, deterring buyers, but the biggest thing, and that's actually easy to guess, was mortgage rates. Almost 3/4 of buyers have decided to pause, and we've seen that here, even with our own business as well, that a lot of people dropped out and said, hey, we're going to hold off and wait until mortgage rates are getting lower. So on that note, let's take a look what the mortgage rates are doing. And you have here a 10-year picture. So you have to look at the very far right end. You can see what happened. We've seen a very dramatic drop in mortgage rates in the last 2 months. The lowest rate that I've seen this morning was 6.25 with the local bank here. With a little bit of luck and good news on the economic front, we might be back below 6, so somewhere in the 5.9% territory, and that psychologically makes a huge difference. Now, what are the reasons why experts are expecting mortgage rates to come down? And I can talk for hours about this, but I just want to give you two very, very, in a nutshell, reasons. Nobody, predicting mortgage rates is notoriously difficult, and a lot of experts, continue to fail on this, but especially on the timing. But the reason why we're expecting rates to come down is twofold. The green line here is the 30-year fixed rate mortgage, and the 10-year is the US Treasury yield. And you can see here over the last 50 years, these two lines have been following each other very closely, and they usually have a 1.72% spread. That is a risk premium that the banks are basically charging over the 10-year treasury. And this spread currently is 2.78%. So the banks are charging a higher premium. That is one contributor of why we have higher mortgage rates. So if the banks are getting more comfortable, that premium is coming down. But the other thing is we're also seeing positive signals from the Fed. They're being content with fighting the inflation with the results that they had. They're signaling that they will lower the rate environment, and this will also help with generally rates to come down. So take those two factors together. That is basically why experts are believing that rates are going to come down this year. Finally, I wanted to take a quick look at big picture inventory. Now, this is specifically for the Milwaukee market. This is a little different number. It's not only single family. This also includes condos and duplexes and multifamily. But it's very easy to see. You have here the seasonal annual fluctuations, and you can see where we're at. We're just extremely low on inventory. And the good news is when you look here on the lower right, it looks like we are starting to change of trend here, going upward a little bit. And I think this will be very welcome news for buyers and will get us a more lively market in 2024. So what can we expect for the Greater Milwaukee area? Rates are stabilizing currently in the 6s. And as I mentioned earlier, with a little luck, we might see 5s later in spring, maybe early summer here. And lower rates, of course, means more buyers. More buyers means more competition. Already very fierce. We're already seeing in the first 3 weeks of January a lot of competition on the market. So don't be fooled. We're starting off basically right back where we finished the year. On the inventory side, a seasonal increase in listings is ahead. We see that every year, so you can count on this happening. But we're also maybe getting a little extra impulse from lower rates that will motivate sellers when they say, okay, buying becomes a little bit more feasible. So let's put our house on the market and make the move that we've been talking about for the last 2 years. Bottom line is be patient. Now is not the time to rush it unless you absolutely need to buy a house. Take a little time and be patient. There will be more inventory and there will be more opportunities. There will be probably lower rates, but with that also on the flip side, a little bit more competition. But use the time that you have now to prepare. And if you want to, feel free to reach out to me. A lot of people are sending me an email after they've been watching one of my videos. You can also go on my website and just directly book a phone call or a Zoom call with me. You have access to my calendar there. Just pick a time that works for your schedule, and I'll see you there. And that was it. Thank you very much for watching, and I'll see you next time.